let's discuss the biggest lie that we've been told related to generating wealth. Now, in the last lesson, I explained how there's two ways to become a millionaire. First, you can earn your way there, or you can own your way there, or some combination thereof. Now, with the first approach, earning your way to becoming a millionaire, I explained how if you earn $200,000 a year, you live off half of that money, you pay taxes on the rest, you're left with $50,000. Now, I also said ignore this related to inflation and reinvestment because guess what? We're going to jump into this topic right now. So I'm going to share with you a story from 20 years ago, which is going to be very pertinent to you. And then I'm going to share something that's really interesting about investing over the long haul. So you're going to want to stick around until the very end of this lesson for sure. All right, this is me right here. 20 years ago, this is Steve. I'll just put 20 years ago. And I was making money in my business and I wanted to put in place a strategy to achieve financial freedom. So guess what? I met with my financial advisor. And my financial advisor said, Steve, look, if you want to achieve financial freedom, you need to have $3 million in assets and then you can live off this investment income. And I said, okay, great. That's a good path. And that's very doable. And I said, okay, let's go ahead and get to work. So we started putting my money to work and I was investing in financial assets and I saw it grow over time. But this is what I want to explain to you. 20 years ago, this house, right here, in my area, just to keep things relative, this is a house here, this is the baseline. A house in the area that I lived in was on average around $300,000. Now, if you compare that to the $3 million right here, that's essentially a 1 to 10 ratio, all right? Now, I want to just explain how this changes over time, so we're going to just keep this in parity. So follow me here. Fast forward 20 years, all right? Go 20 years ahead, and the same house is now worth $1 million. So now this house value, 1 million compared to the 3 million, is now not 1 to 10, it's 1 to 3. Now, the reason why I'm explaining it this way is because, check this out. This $3 million that I was told that I need to have in order to live this great retirement and achieve financial freedom was not necessarily a correct number. Why is that? Because of inflation, right? And the erosion of our purchasing power, which means a dollar today is worth more than a dollar in the future. So with inflation, home prices go up. So we may think, oh, look, we're getting richer, our home price is going up, our value's going up, and we have more money. But in parity to this target right here, actually, it was getting less. So $3 million sounded like a good target 20 years ago, but in the future, right, this could only buy me a fraction of what I was able to buy in the past, right? This 1 to 3 ratio. So that's the lie that I want to discuss right now is that, let's say that was 20 years ago, add another 10 years and 30 years, what if this house, the same house, is $1.5 million? Well, that's 1 to 2. So this $3 million target is not super realistic. So if you are trying to plan for your future and you're trying to figure out how much money you need in retirement, you have this moving target because sure, you know, you may have this path right here to get to retirement, but as inflation creeps in, this erosion of your purchasing power makes this number actually become a lot bigger. So you're trying to chase retirement, but the cost of living goes up and up and up, and your dollars don't go as far. All right, let me just illustrate this in another way. And this is why I'm so bullish on business. And that's why I believe it's so critical to build financial skills, especially in the world of business, okay? Because finance is the language of money and it's the language of business. So you have to become fluent in finance in order to drive value. So let me explain. Let's say You have 100 G's, okay, 100 grand. And you're going to invest that over 30 years. Now, there are a variety of asset classes you may choose to invest in. So I'm just going to keep things really simple and I'm going to round the numbers here. But let's just say we take this $100,000 and we put it into cash. Now, with this cash, we just decide to put it in a money market account. And let's say on average, we earn 1%, right? Now, interest rates are a little bit higher right now as far as what you can earn on a money market account. But just remember, not too long ago, interest rates were 0.0 something, or whatever you earn was so minuscule on your savings or your money market account. So I'll just say 1% on average. Now, if you take this cash, $100,000, and put it in this type of account and you earn 1%, guess what? You will end up with $135,000 in 30 years. Now, you may say, Steve, I know it's not a good idea to put cash in this money market account or bury it in the backyard or put it under my mattress. So you decide instead to invest it in bonds. Now, if you do the same thing, and let's say you earn a 5% return on bonds, that same amount of money, that same 100 grand, would be about $447,000. Now, I'm just rounding these numbers up for simplicity. What if you decide to invest in real estate? Because you're like, real estate is better than all these, da-da-da. And let's say you're able to earn a 7% return on average. Then your money, your $100,000 would grow to $812,000. So much bigger, 8x what you would earn essentially on cash if you put your money in real estate. Now, what if you put your money in the stock market or you invest in equities and you're able to earn a 9% historical return? Well, this is where it starts to get really exciting because now this number grows to $1,473,000, or in other words, 14 times nearly what you can earn in cash. But this is where I get really excited. If I was excited about this, just wait. Because what if you put it in business? You put this money in starting a company. You put $100,000 in starting this business. And let's just say you earn a 15% return. Now, sometimes the return on invested capital for companies can be 20%, 30%, or 40%, right? And then if you're able to do that, you would earn $8,750,000. All right. So look at that. $100,000 you start out with, and you end up with $8.7 million. So here's my point. Where you put your money does matter. Now, I'm not saying it's a bad path to work for a company and to earn wages and to get your annual raise and to get your bonus. I'm not saying that's a bad path at all. I'm just pointing out that if you want to live a better financial life, if you want to achieve true financial freedom, and if you want to retire, right? One of the best ways to do that is through business. Now, you can own the business, or you could be part of the team that is growing the business and have ownership or equity in the business. But this is the upside that I'm referring to. And that's why I'm so excited about finance, because if you can understand the story behind the numbers, then it's going to make all the difference in the world. But let me just illustrate this with one more point here. Let's say you are running a business, and this is why financial literacy is so critical. Whether you're a business leader or whether you own the business. And let's just say you have $1,000 in revenue in top line sales. Your cost of goods sold, all the costs associated with earning this revenue, are $700, which leaves you with a gross margin of $300. And then you have your operating expenses, which I'll just abbreviate with OPEX, are $400. And you have profit of negative $100. My question is, if this was your situation, whether you are a business unit leader, a CEO, or the owner of this company, how would you improve the business? So if this is your financial report card, if this is what you're looking at, how do you make a difference? How do you apply a strategy in order to improve the bottom line here? And that's what we're going to get into here in just a minute in the next lesson. But that's why financial literacy is so critical, because you have to look at these numbers and then say, okay, I know the 3 things I could do here to improve this. I know I could do these 4 things. I'm going to go try them. I'm going to go execute, and then I'm going to improve the bottom line. So going back to that last example where I was listing out all the assets and their respective returns, if you want to earn a 15% return in business, you have to know the numbers, and more importantly, the story behind the numbers, and then do something about them in order to maximize firm value. And we're going to keep going. In the next lesson, we're going to walk through the answers to the financial IQ assessment, and then I'll provide you with some more essential things you should know pertaining to this. So let's keep going.